Hello guys, welcome back, and we are going to tackle bank reconciliation statement. Bank reconciliation statement. So I know you have a lot of questions, but just know you are well, you are well prepared for this. So make sure you have your pen there, you have your calculator, you have what, but today we are going to look at the theory first, and then the next video you're going to check the workings. So for bank reconciliation statement, I know most of you have tried this but they had problems. I found comments, so I've decided to come back with this topic, bank reconciliation statement. And remember, if you have done cash book, there is no difference. The only difference, remember, bank is between bank and the business. So at this point we are going to define some key terms here. So first of all, let's start with let's start with bank reconciliation statement. Bank reconciliation statement. So what is bank reconciliation statement? Remember, bank reconciliation statement, it is a statement prepared to link the bank balance in the cash book with the balance shown in the bank account. That link, okay, that link. So it is a statement, let me write it for you. It is a statement prepared, it is a statement prepared to link the bank balance, to link the bank balance in the cash book with the balance shown on the bank statement. So that's a bank reconciliation. That's a bank reconciliation statement. The definition: it is a statement prepared to link the bank balance in the cash book with the balance shown in the bank statement. That is a bank reconciliation statement. Then the other thing is about timing difference. Timing difference. You'll find out that later. This is the main reason that make the statement of bank balance in the cash book differs with that in the bank statement. So what is a timing difference? Difference between bank statement and the cash book that will be corrected over time, such as, for example, we have unpresented checks and outstanding lodgements. That is difference between the bank statement and the cash book that will be corrected over time. So okay, that will be recorded over time. So this difference between the bank statement, difference between the bank statement and the cash book, that will be corrected, over time. Okay, e.g., for example, we have what? We have unpresented checks and outstanding. We call it the outstanding, which word? Lodgements. Yeah, outstanding lodgements. So that's about timing difference. That's what we call timing difference. So from that two definition, we have realized we have another two terms that we need to know: unpresented checks and outstanding lodgement. So what is unpresented checks? from even that word, what is an unpresented checks? You'll find out amounts that have been paid into the bank but not yet recorded on the bank statement. Okay, someone give you a check but you haven't taken it to the bank. Okay, that's an unpresented checks. So these are amounts that have been paid. Let's say someone have purchased something in your company and give you a check, but you haven't presented it into what? Into the bank. So amounts that have been paid into the bank, but not yet recorded, on the bank statement. So that's unpresented checks, amounts that have been paid into the bank but not yet recorded on the bank statement. Amounts that have been paid into the bank but not yet recorded on the bank statement. Okay, then we have unpresented checks, not to call an outstanding lodgements. So what are the outstanding lodgements? Remember this: checks that have been issued but have not yet been paid in and deducted from the account of the business. Okay, checks that have been issued but have not yet been paid in and deducted from the account of business. So good, hope you have written that. I've said checks that have been issued but have not yet been paid in and deducted from the account of the business. So at this point we're going to find out that purpose. We're going to check the purpose of bank reconciliation. What are the purpose of bank reconciliation? So let me say this: remember that one tool of maintaining proper record discipline is to ensure that all receipts are banked into the bank account intact. Okay, so bank sends in their customers a record of their transactions made through what? That account, in the form of bank statement. It shows money lodged into the accounts. Okay, it shows that there are some money that have been lodged into the accounts, that is described in the bank statement as what? Credits. Okay, and money paid out, that is described as what? Bank statement as debits. The business records bank transaction in the cash book. We all know that bank column, that is in the bank column. Okay, now it is possible that some of the entries in the cash book differ from those of the bank due to what? For example, time lag in the receipt of the information or due to errors. Okay, so often when a comparison is made between the bank balances, okay, and that in between the bank balances, okay, the two balances will be different. Okay, so avoid that, maybe errors, time differences. So it is for this reason that a bank reconciliation statement is prepared to do what? To reconcile the two balances. Okay, so the reconciliation may identify errors that may have been made in either the firm's cash book or in the bank's record. How? You will find that in the business cash book there is a shortage of some money. Okay, later you'll realize that there is a check that you didn't add up, or you didn't place it in an appropriate ledger account, or you completely miss it out. Sorry. So you find out, and a bank statement is a copy. For those who are wondering what's a bank statement, it's a copy of the business bank account transactions that are recorded by the bank. Bank statements are regularly sent out to customers, usually on the monthly basis. This enables the customer to check their funds in the bank regularly, okay, and to update their records accordingly. Okay, so that's all about. So let me write this for your revision purposes. Like a bank statement is a copy of the business bank account transactions as recorded by the bank Good. Okay, so you find out those are, like, you will realize that's the definition of a bank statement of a bank. Good. Then the next part, you're going to check causes. Make sure you research about purpose of the bank reconciliation after I've explained that. So causes of differences between cash and bank balance. What are the causes? What caused the bank balance and that cash balance to differ? Okay, and I've raised one point there. We have time differences. Sorry, time differences. Okay, time differences, that is in recording transactions. Sometimes that time when recording transaction may cause the difference between cash and bank balance. As an accountant, always be timely. Okay, when given a check, make sure you go straight and record that check. Okay, and the time, mostly the time. Why? Because let's say you're being given a check in the morning, then later on you record it in the evening. This tells you that there was, if for example you record that in the evening, what about the transactions that were in between? Okay, even when working out these questions, you are always given some time, like it is first November blah blah, second of blah blah. Yeah, that is it. Record your, be chronological. Okay, be chronological, whereby, and you will avoid this part. And for that time differences, remember these are differences caused by time lag in the receipt of information or recording of transaction between the bank and the business. And we have almost 6 examples here. Okay, so I'm going to highlight them, then later on we're going to explain each in another video. Okay, so number 1, in time differences, we have unpresented checks. Then number 2, remember unpresented checks are checks paid out by the business, but the recipients have not presented them to the bank for payment. Okay, that's about timing. Unpresented checks are checks paid out by the business, but the recipients have not presented them to the bank for what? For payment. For instance, the business paying cashier may send checks out to suppliers, some of whom may pay in the checks of the bank immediately, while others may keep the check for several days before paying it in. Then number 2, we have uncredited checks. Uncredited checks. Yeah, these are checks received by the business but not credited into the bank account. I see. You have received a check as a business, but you have not yet credited in the bank account. For instance, the firm's records are received on in the cash book from the bank paying in slip. However, the bank may not record the receipt for a day or so, particularly if it is paid in the day, or if it is paid in at a bank branch other than what the one at which the account is maintained. Okay, good. Then we have number 3, direct credits. Direct credits. Another timing difference may occur when the bank has received a direct payment for the business. In the instance, for the bank will have recorded the receipt in the business account at the bank, but the business will be unaware of the payment and will therefore not have recorded the receipt in the cash book. Why? Mostly this happens. You find out that that a bank has add some payment into the business account, but the business is not aware if there's some money have been added in their bank account, so they will not record it in the cash book. For example, standing order for incoming payment received on the business account, e.g. payment from debtors, that is customers, when the payment has not been advised to the business. Let's say customers they have taken their check to the bank and paid into the business account, but the business is not aware if there is any adjustment have been made in the account, so they will not. Okay, that's a direct credit. This is also the reason why they do not balance. Then we have bank charges. Also, before I go to bank charges, we have, for example, interest and refunds created by the bank. Those interest, business is not aware. Okay, business may not be aware that there are some interest, okay, that have been adjusted in their account. Then we have bank charges. Also, this business may not be aware of any bank charges. Then we have payment of standing order. Payment of standing order. Then let me explain payment of standing order. Payment of standing order are instructions to the bank to execute payment on behalf of the business. Like a business instruct a bank to pay this particular person this amount of money. Okay, normally periodically payment like insurance are best executed by way of standing order. The business will not know about the execution of the payment until the receipt of the bank statement is given to them. Okay, the standing order will appear in the bank statement but not the cash book. Then number 6, we have what? Unpaid checks. Unpaid checks. Remember, these are the checks paid in and out of the business account, but which are either stored by the drawer or are returned as dishonored checks. Okay, so those are the causes of differences between cash and bank balance. On our next video, we are going to check difference caused by errors. This will be on our next video. Difference caused by errors. Good. So thank you guys. It's Topic Kenya. So make sure you have subscribed so that you will expect this video later on. Ring that notification bell, and thank you.